Well, good afternoon. Happy Friday, March 19th. Mark Milam here, your mortgage professional with Highland Mortgage, coming to you with this week's interest rate summary and market update. Now, unless you've been under a rock for the past month, you've heard that interest rates are headed north. Interest rates are rising. Lots of confusion and concern about this. How high are they going to go? Why are they moving higher? Why are they moving higher so quickly? And really the purpose of this post is to give you some insight as to what's going on, what's affecting mortgage interest rates, why is this happening, and where are we going? So without any further ado, let's kind of flip the screen around here and let's talk about this. So what's happening or happened to interest rates, right? And it's a bit of a perfect storm. So let's walk through this. So to understand what's happening with mortgage interest rates, you need to go back and do a little Mortgage 101, which is that mortgages are just long-term bonds. That's all they are. They're an investment in a long-term bond. And bonds hate inflation. Why? Bonds hate inflation because it erodes their value over time. Now, when you think about this, think about the fact that if I loaned you money at a given interest rate at 2.5%, 3%, and you're going to pay me that money back over 30 years, and over the course of those 30 years, you're paying me back at 3%, and the inflation is going up, which means the value of each dollar you're giving me is going down because inflation is going up. Well, that fixed payment that I'm receiving is suddenly worth a whole lot less than when I gave it to you, right? As inflation goes up, you're still paying me the same 3%, but the dollar value of what you're giving me isn't as powerful, and that's because inflation erodes the value of bonds over time, all right? So we have to understand that mortgage rates hate inflation. So think of inflation as the car that we'd like to keep in the slow lane, okay? It's fine for it to move, but we don't want it to move too fast. We want to keep inflation in the slow lane. So knowing that, what's affecting inflation? Well, first of all, we have a very effective vaccine, or really we should say vaccines, right? We have multiple vaccines. 30% of the country is now vaccinated. We know that herd immunity happens somewhere between 75 and 85%. We know that's when we reach herd immunity and effectively the country can reopen. Businesses are already reopening. We see several states lifting restrictions entirely. Whether that's a good idea or a bad idea, it's going to have an economic impact. Think of the vaccine now. If we go back to that inflation car, think of the vaccine as clearing the road for that inflation car to get moving and to get moving swiftly, right? So there's one factor. There's the vaccine. The next factor is we had a record savings rate in 2020. Take a look at that chart, and you can see the savings rate there in 2020 eclipsed 33%, which is unheard of. So what does that mean? The personal savings rate in the U.S. in 2020 exceeded $2.3 trillion. People are not going out and going on vacations. People are not going to sporting events. People are not going to concerts. They're saving their money instead, or they're investing their money, which has created what? A euphoric stock market. I'm sure you've been watching the stock market, hearing about all the records that the stock market has broken time and time again throughout the latter half of 2020 and early 2021. So think of this stored, invested money, this record-breaking savings rate, as the gasoline for that inflation car. Okay, think of it as sort of the powder keg for that inflation car. So there's another factor. Here's another one, the Fed. We have a very accommodative Federal Reserve led by Chairman Jerome Powell, who spoke this week. Now that the Fed is continuing to buy up $120 billion per month in treasuries and mortgage-backed securities, and they've given no indication that they're going to taper those purchases. They've reiterated time and time again their intent to keep the Fed funds rate, that's the overnight lending rate, that's not a mortgage rate, that's the overnight lending rate, but they've reiterated their intent to keep that rate at the current levels until 2023. Now, the Fed typically uses the Fed funds rate to slow inflation, and if they're saying they're going to keep that rate at the current level, which is between 0.25% until 2023, well, that's not going to do much to slow inflation, okay? And that's giving the market a whole lot of advance notice that the Fed does not intend to step in and raise the Fed funds rate anytime soon. They're also they've expressed a willingness to let inflation run over and above the benchmark 2% target for inflation. That's a bit of a concern. So in other words, we have easy money and we have lots of it. So think of the Fed now as the engine of that inflation car, right? We've got the gasoline now, we've got clearing the road, now we've got the engine. Now, what is another factor that might affect inflation? Yes, the stimulus. And many of us have received a stimulus check. Some have received more than others, dependent upon how many children you might have. But the stimulus is $1.9 trillion is now hitting the accounts of Americans. There's an infrastructure bill expected on the heels of the stimulus bill, and that will be funded with trillions of dollars as well. Now, this comes on the heels of the CARES Act, which was Donald Trump's stimulus package that's already made its way to the pockets of millions of Americans. So think of the stimulus here now as the gas pedal of the inflation car. We've got the clearing of the road, we've got the engine, we've got a powder keg of gas, and now think of the stimulus as pushing that pedal down on that inflation car, moving it out of the slow lane and really speeding things up. But there's a second part of the stimulus to be aware of. Now, we have to pay for all the stimulus, right? It doesn't come from nowhere. So how do we pay for trillions upon trillions of dollars in stimulus? Well, among other things, we have to auction off treasuries. We have to auction off government securities to generate revenue to pay for the trillions of dollars of stimulus that both the Republican and the Democratic governments have voted for and have enacted. So to do that, we have to auction off these treasuries. Well, more supply of anything erodes the value of it, right? If you have an endless supply of something, then the value of that thing is eroded. And as the value of that thing is eroded, and when it turns into treasuries or government bonds, the interest rate on it has to go up. You have to incent people to buy them, and the only way to do that is by raising the rate. If the auctions are received poorly, and several of the auctions have been, some of them have been more modest in terms of the interest, but the interest overall could best be described as tepid. Not very strong interest in these bond auctions, which creates a problem, right? All of these things lead to inflation. So think of the part two of the stimulus here as a steep downhill slope for that inflation car, right? So all of that has led us into this higher rate environment that no one saw coming quite as perfectly as it's coming now. And it is truly the perfect storm of factors that are leading us here. So what's next? Well, when we talk about what's next, we have to talk about short term and then long term, because it's a very dynamic environment. Now, short term, unfortunately, we're going to get more of the same. Interest rates are going to continue to rise. You're going to have days where we plateau. We might see slight improvements, but for the most part, we're talking 2 steps up and 1 step back, this slow progression of rising interest rates. When you think about inflation and how it's reported year over year. So what were we doing this time last year? Well, this time last year, we had already announced that we had a global pandemic. We knew that the economy was starting to suffer. We actually were beginning a contraction. The economy was beginning to contract. So this time last year, inflation was negative. And now we're reporting inflation this time this year, and we are referencing where we were last year. So inflation numbers are about to spike simply as a function of how they're reported. They're reported year over year. We know this time last year there was no inflation. So inflation numbers are going up. So expect rising rates and expect them through the spring and into summer. Now, let's talk about long term. Where are we headed long term for interest rates? And while no one can look into a crystal ball and tell you perfectly what's going to happen with interest rates, we can tell you there's a growing sentiment of potential easing of interest rates in the fall when the year-over-year numbers are not going to be quite as dramatic in terms of inflation, and possible recession in 2022. Does that make any sense? Possible recession this time next year. Why would that happen? Well, we still have lots and lots and lots of global debt. The sheer quantity of global debt that has been incurred over the pandemic acts like a weight. It acts like gravity on the overall debt, overall interest rates. That global debt is a problem. Also, many factors that are impacting inflation. A lot of these factors that we've gone over in this presentation that are impacting inflation are temporary. They're ephemeral, right? They're not going to last. The savings, we're not going to have a 33% savings rate in 2021. We're going to start to spend that money. That's going to work its way through the economy, and the savings rate's going to relax. We're going to get back to a more normalized environment. And then the big one is the stimulus, right? We're not going to receive stimulus checks every 3 months like we've been over the past 6 months here. We're going to start to see a more return to normal for the economy. And some of these shot in the arm, no pun intended, some of these shots in the arm that we're getting that lead to short-term inflation are not going to be there long-term. So all that being said, hopefully that gives you some insight as to why we're seeing these rising interest rates and where we're headed in the short term and the long term. If I can be of any assistance to you, please don't hesitate to reach out. Mark.Milam at highlandmtg.com 404 395 1102. Thanks.